Hello and welcome to this episode of Macro Sutra. I'm TCA Sharad Raghavan, Deputy Editor at ThePrint. And now the year 2024 is coming to an end and we have 2025 ahead of us. Everywhere you look, people are talking about the year that's gone by. But what we want to do for you is to give you a little snapshot of what the Indian economy can expect in the year ahead. It's somewhat optimistic, somewhat pessimistic. I mean, that's the way the world is. But to discuss all of this, we have with you Radhika Pandey, Associate Professor at NIPFP. Thank you so much, Radhika, for joining us.
Thank you, Sharad.
So now, Radhika, the big question, as they say, mota question, the Indian economy, are we, number one, are we likely to be the fastest growing economy in the world, major economy in the world in 2025? And will we still remain the fifth largest economy in the world?
So yes, India is likely to remain the fastest growing major economy in the world. As if we look at the various projections, the IMF, the World Bank, there is no doubt that India is going to remain the fastest growing major economy, and it is also expected to surpass Japan to become the fourth largest economy in terms of the size of the economy, in terms
Right.
of what we say the nominal income. So if we are already a $4 trillion economy, so towards the during the course of 2025, we are most likely to surpass Japan to become the fourth largest economy. And then going forward in the next 2-3 years, we are going to become the third largest economy by surpassing Germany.
Fantastic. So, well, that's the good news. But some of the worrying news is, of course, Donald Trump.
Right.
And in January, he's going to take over as the president. And along with that, there's the fear of tariffs, of the strengthening of the dollar, and of the US government bond yields rising.
Right.
And the thing is, we've already seen the impact of two out of three of these. Tariffs, of course, have not happened because he's not president yet. But the strengthening of the dollar and the bond yields have already hit India.
Right.
In 2025, do you think that this will continue, or is it just a lot of noise and it'll just fade out in a whimper?
So, in terms of the dollar strength and in terms of the bond yields, I think it's expected to continue
Okay.
because the another factor in parallel has been the monetary policy announcement by the U.S. Fed, which also stated that going forward the extent of rate cuts would be much lower. So there would be only two rate cuts. So all these policy pronouncements impart strength to the U.S. dollar, and in general, Trump's policies are going to be inflationary in nature. Talking about corporate tax rate
Yeah.
cuts, talking about imposing tariffs that will lead to increase in the price of American imports. So all these policies in general, regardless of whether they have an impact on India or not, they are going to be inflationary for the US. So
Mhm.
it is going to lead to higher bond yields. So higher bond yields and higher and a stronger US dollar, these two factors are expected to continue at least in the initial part of 2025, and they do have implications for India as well as for emerging economies, because if the US dollar rises, it puts depreciation pressure on the emerging market currencies, including India, and which we are
Yeah,
already seeing.
of course.
The pace of depreciation has quickened from 84 to 85, happened in a very short span of time as compared to how much time it took for the rupee to depreciate from 83 to 84. And now people are talking that rupee may well surpass 87 rupees per dollar mark. So there's going to be a lot of volatility in currency as well as in financial markets in 2025, owing to these two factors, namely the strength of the US dollar and increase in the US bond yield. Also, because the US fiscal deficit and debt is going to rise because of all these expansionary fiscal policies.
Mhm.
So, they are all going to have an impact on the dollar and the bond yields. As regards the tariff is concerned, it is very uncertain whether it's just a negotiation tactic or whether actually tariffs will be imposed on Indian goods. But nevertheless, it has led to a lot of activities within the ministry. They are talking about adopting various strategies, giving some kind of tariff cuts on agri products, uh, coming into some kind of a mini trade deal. So all that will become clear when Trump assumes office. But on the dollar front and on the bond deal, it's quite certain that this will continue, and this volatility will continue over the next couple of months. And this has implications for rupee and for our financial markets, because we've already seen that the 10-year bond yield differential between rupee and the dollar has narrowed substantially.
Right.
It's already reached 2.2% and as in the initial part of 2024 it was 3.2%. Now it's around 2%, the differential. So all that has implications for foreign investment inflows. It
Yeah.
will lead to outflows, because if we want to propel foreign investors to invest in riskier assets, the differential has to be wider
Yeah,
to take into
absolutely.
account of currency fluctuation, to take into account the risk of currency and so on. But so we have to brace for currency volatility and market volatility, at least in the initial part of 2025.
And just a few days ago, the RBI came out with its latest bulletin,
Right.
monthly bulletin, and in that they had mentioned that the real effective exchange rate, which is they peg the rupee to a basket of currencies, not just the dollar. So that is showing, according to the RBI data, that the rupee is still overvalued,
Right.
which means that there's still space for further devaluation to happen.
Absolutely, that is
Right.
correct, because RBI has been intervening, and in fact, in the same bulletin, we got the intervention data
Hmm.
also, and the net RBI sold $9.2 billion. That means RBI has been intervening heavily to manage the
Yeah.
rupee. So there is a scope for rupee to depreciate, given by the metrics of RER also, real effective exchange rate. So there is a scope for rupee depreciation, and therefore there is now a lot of talk about that now RBI should allow rupee to depreciate. That will help in export competitiveness. That will help in our current account balance as well. And intervention is leading to all sorts of unintended consequences in the form of tighter liquidity, which is not what we want at a time when credit demand is already getting weaker.
Right. But then the other side of these things are that, of course, that we might start importing inflation because
Right.
we're so dependent on imported goods.
Right.
If those become more expensive, so it's of course it's very complex. But coming to the next topic, it's private investments. Now,
Right.
these it's been growing, but it's not been growing fast enough as a share of GDP. It's been falling, or it's been at the same level
Same
for a
level.
while. So, do you feel that the next year we'll see a turnaround?
So that is very crucial, because now what will happen is that we've seen that since in the post-pandemic period, government investment as a share of GDP has been rising, and if we go by the budget estimate of the FY25, it's already reached 3.4% of GDP.
Right.
Capex as a share of GDP, and now if the government has to focus on fiscal consolidation, there is a limited scope for further keeping on increasing capital expenditure. In absolute terms, it may be increased, but as a share of GDP, I think it may have peaked. The ratio may have peaked,
Mm.
and therefore it's time for private investment to take up the next phase of capex resurgence. But as you said, if we look at despite a set of favorable conditions, despite deleveraging, despite lower leverage, despite cut in corporate taxes, and despite government providing the necessary headroom through its own capital expenditure, we don't see private investment picking up in a sustained manner.
Yeah.
There are sectors like, say, semiconductors, where it is picking up, in some pockets of steel, it is picking up, but it's not picking up in a sustained manner. And a part of the problem lies in consumer demand, because unless and until the overall investments are driven by demand, and unless and until we see a sustained increase in consumer demand, it's not possible for private investment to pick up. And that is what is reflected even in the capacity utilization. Till now we see
Exactly.
that it's not yet surpassed the critical 75% mark. It reaches it, the crosses, again it comes back. So
Yeah.
that is very crucial, that next year or so we should see a revival in demand, and some pickup in private investment, because going forward it will become difficult for the government to continue increasing capital expenditure without having consequences for its fiscal math. So that is the crucial choice that it has to make.
Absolutely. And so then naturally, my next question is going to be about demand,
Right.
both urban and rural demand. Do you see a pickup happening next year?
So, see, there are, again, it's a very interesting mix. As we saw since post pandemic, we've seen that consumption demand has seen uneven recovery. Post pandemic, we saw urban demand picked up, but rural demand did not pick up. We saw there was a increase in demand for premium products. We saw a surge in pent up demand. And now the story has shifted to rural demand. We see that since this financial year, we have seen that rural demand has been picking up due to
Right.
a confluence of a number of factors: monsoon, increase in minimum support prices, increase in sowing, and also what is playing its part is that agricultural cost inflation seems to be coming down.
Mm.
Fertilizer prices are coming down. So, all these are giving a boost to farm income and therefore helping in improving rural demand.
Right.
But on the other side, urban demand, the pent up demand phase is now over, and now we are seeing kind of a normalization. And also, very important factor here, or kind of a troubling thing that we've seen in the recent RBI's data, is about the household financial liabilities, where
Right.
we've seen that in FY24, household financial liabilities have jumped from 5.9 to 6.4% of GDP. And in terms of the overall outstanding stock, it has risen to household indebtedness has risen to 41% of GDP. Now, this is something which is going to weigh on consumption in the coming year, because
Of
the
course.
debt servicing burden will rise, because the indebtedness has risen at a very fast pace in the post pandemic period. And on the other side, savings, the net financial assets or the net financial savings have increased, but they haven't picked up at a commensurate rate. So it's only 5.3% of GDP in the last financial year, as compared to 5% in 2022-23. This data comes with a lag, but it gives us important signals about where consumption trajectory may be headed in the coming year. So on the one side, we've seen that bank credit data, we see that overall personal retail loans are gradually moderating due to
Yes.
factors that we've discussed earlier. But at the same time, because of the increase in household indebtedness, there would be some amount of allocation towards repayment or debt servicing,
Of
and that
course.
will have a bearing on consumption revival. But on the other side, as I said, rural demand is expected to sustain the momentum in the coming year as well, because various agri commodities and even inflation in general is expected to be not so much of a major challenge, other than the impact through rupee depreciation and of course the climate
Of
related
course.
thing.
Yeah.
But the typical drivers of inflation in the form of global commodity prices, they are not going to be as problematic as we saw in 2022, when oil prices were rising, food prices were rising, oil seed prices were rising.
Hmm.
So the World Bank's commodity price outlook is a very useful report to get a glimpse of commodity prices in the coming year. It shows there is a projection of a 5% decline in commodity prices. So, all that is a very positive, it has a positive impact on inflation going forward. Of course, the headwinds are there, but that will help in giving a boost to rural consumption further.
Right. And but the thing with rural demand as well, as opposed to urban demand, is that it's very dependent on things like the monsoon.
Absolutely.
And so this time around, we had a pretty decent monsoon,
Right.
but these things come in cycles. So next year,
Absolutely. Yeah.
hopefully, it'll be a fine monsoon. I mean, 2 years of sustained good monsoons can do wonders to the rural economy. But climate change is
Yeah.
such as it is.
Yeah, that uncertainty is there,
Yeah,
but it's just that based on the other factors, namely the agri cost inflation and all the factors that have changed for the better, we can say that at
things are at
least,
least better.
yeah, yes.
Yeah, absolutely. And so on, yeah, the outlook on inflation, you say that it's not going to be as bad next
Yeah,
year?
it's not going to be as bad because the typical drivers, as I said, in terms of the oil price shock, that
Right.
is not going to have a very a significant impact on inflation, because even this year around, despite so many exogenous shocks, despite geopolitical conflicts, there were period of short-term spikes in oil prices, but we did not see a very sustained hike in oil prices.
Yeah.
More or less, in the medium term, oil prices were stable. So they are expected to remain stable. In fact, they are expected to decline if we go by the World Bank's commodity outlook report. So if oil prices are expected to be stable, it has a positive impact on inflation.
No, without a doubt. And finally,
Also, sorry, one,
yes.
the sowing has been good, so that will have an impact on the
Yeah.
wheat production next year, and that again will have an impact on food inflation. So all these factors do show that inflation is not going to be that major a problem that we've seen in 2022 and 23 particularly. But of course, there are two major challenges. One is, as you said, the impact of imported inflation due to rupee
Hmm.
depreciation, and the other is the climate change impact.
Yeah. And finally, to round out this discussion on the economy, trade, how
Trade.
is that likely to
So trade
go?
again, we saw the goods and services exports are moving in different direction.
Yeah.
The goods exports are expected to remain at the same level, not expected to post a very, they're expected to remain volatile because of the global conditions. Mainly in EU, the global demand is not expected to pick up
Hmm.
substantially in the next year as well. So goods demand is very sensitive to goods trade, goods exports is very sensitive to global demand condition. So that said, but services exports will continue to provide a cushion to our overall current account deficit. And also remittances, that's a very important part of our current account. So we have goods, we have services, and we have primary and secondary income.
Hmm.
And remittances are an important part of our secondary income. So remittances and services exports will provide cushion to overall current account deficit, and therefore is expected to remain around 1 to 1.5% of GDP, which is manageable in the
Yeah, that's not bad.
current global challenging environment.
Okay, and now we have a few questions from the audience. There's somebody who hasn't left their name. They ask, is there any major economic reform expected from the government in 2025-26? And on the trade front, how is India going to adjust to Trump's policies, especially regarding India's exports to the US?
Yeah, so on the economic reforms, I think we should take this as a continuous process, and we should see, depending upon what the FM had announced in the July budget,
Hmm.
whether some of those things materialize, or do we get an update of some of the announcements that were made in the July budget. For example, one of the major change that was announced was a shift from fiscal deficit to debt-based
Yes.
anchoring of fiscal policy. So now, by FY26, we'll have a fiscal deficit based target, which is expected to be around 4.4 to 4.5% of GDP. But the next year's budget should provide some indications of the contours of the new framework. With the new framework, which is that fiscal deficit will be set in a way that debt to GDP ratio reduces. So,
Yeah.
what is going to be that framework? It will be good that if the government is able to come up with some strategy or some outlook on that. So that is one thing. The other thing what was announced was a comprehensive review of the customs duty framework. So
Correct.
it will be good to know whether there is some update on that, because that has an important bearing on manufacturing sector competitiveness, that has an important bearing on our trade. And lastly, a more medium term thing, which was what the FM announced about an economic policy framework, which would be set up in collaboration with states, which will focus on improving labor and capital productivity.
Yes.
So is there some update, or some thought process, some uh, starting of the work on developing that framework? So there should be some discussion about that, because that's an overarching reform that would help boost the long term productivity and long term growth prospects of the economy.
There was a
So
direct tax code also that.
direct tax code also,
Yeah.
though I think we might not see any further progress on that, but at least again improving tax compliances on that, we should see some progress. But in terms of real reforms, I think what is needed is a more clear enunciation of the fiscal policy framework going forward on customs duty, something what needs to be done to boost consumption and to boost labor intensive manufacturing, because these are the two important
Yeah.
things. Because consumption is something which, if consumption picks up, that will also give a heads up to boost to private investment as well.
Absolutely. And on the Trump aspect, Radhika already spoke about it towards the beginning of the show. So Vivekanandan, he asks, we see FMCG companies reporting poorer than expected numbers, meaning that the poor and middle class is affected, which gets ratified further with microfinance companies reporting increasing non-performing asset numbers increasing. What exactly should we do to improve the state of people at the bottom of the pyramid? Won't that be the biggest boost to local consumption and thereby the economy?
Absolutely, that will be the biggest boost to local consumption. And what is required is to have a strategy towards boosting labor intensive manufacturing on the one side, and also to look at the state of MSMEs in the country, the micro, small, and medium enterprises that have the potential to provide employment to a lot of workforce. We've seen that, and they have they are contributing to GDP, they are contributing to exports. So, a wholehearted, holistic MSME strategy focusing on employment will help in improving the state of the bottom of pyramid people, and also boost employment in the labor intensive manufacturing. We've seen some initiatives that were taken in the last year's budget, but those need to be supplemented with a more comprehensive approach toward employment intensive strategy. Any policy decision that is taken, even towards in the on the tax front, needs to be looked at through the lens of what it will do to its impact on employment, whether it will
Absolutely.
generate more employment or whether it will have an adverse impact on employment. So, employment generation is the key element towards boosting the incomes of the bottom of pyramid people.
Absolutely. And V. Madhava Peddi, he asks, is India going to slow down like China, leading to a real estate and stock market stagnation or crash?
See, we must understand here that the diagnosis of the problem is important. In China, the problem is due to supply glut,
Yeah.
overcapacity, and focus on supply side initiatives and deflation. And these are not the factors that are currently in India. We do not face deflation. We do not face overcapacity. So I don't think we are going to. And there, the problem was due to real estate, because a lot of emphasis was placed on real estate. There was increase in supply, there was crisis of confidence, and that led to a downward spiral of consumption, investment, and so on. All the engines of growth saw a decline.
Yeah.
That is not something that we are seeing here. We are still growing at 6.5%, and we are expected to grow between 6.5 to 7%, though there are some weaknesses that we need to address in the form of boosting consumption and pick up in private investment, and ensuring that our exports, we need to have a strategy to deal with Trump related uncertainty. Whatever negotiations are required, that needs to be done. If a mini trade deal has to be formulated, it should be done. But and in all this, the angle of employment should not be forgotten. And in fact, if these things are taken care of, I think India will grow at a steady pace.
Great. So that actually is the perfect summing up. She's covered absolutely all of the aspects that we talked about. So, on that note, that's all from us. But before we go, please have a wonderful new year. Wishing all of you a lot of success from all of us here in the Macro Sutra team and, of course, the print. Thank you so much for watching.